Namaskar. In this lesson, let us try to understand the latest developments in banking laws of India. The Indian fintech sector has diversified and expanded beyond back-end technologies and digital payments to cover more financial services such as lending, insurance, brokerage, mutual funds distribution and wealth management. The performance of the Indian banking sector is intimately correlated with the overall health of the economy, perhaps more so than any other sector. The sector is tasked with supporting other economic sectors like agriculture, small scale businesses, exports and banking activities in developed commercial areas and remote rural areas. The improvement of asset quality, application of rational risk management procedures and capital adequacy are some of the main functions of the Indian banking system. Banking sector reforms are envisaged to improve the conditions of the banking system. Multiple banking sector reforms have been introduced in India in the context of economic liberalization, privatization and globalization, popularly known as LPG. The main objective of the banking reforms is to improve operational efficiency and promote banks' health and financial reliability so that Indian banks can meet internationally recognized standards of performance. In 2021, the world suffered through multiple waves of COVID-19 pandemic, bringing supply chain and logistics disruptions. In order to restore and sustain the growth on a long term basis, while ensuring that inflation stays within the target range, India's Monetary Policy Committee decided to maintain the status quo on the policy repo rate. It may be seen that the overall banking sector in India has evolved significantly over the last decade, from being major lenders to the industry to being the majority providers of personal loans, vehicle loans, credit cards and housing loans. Private banks are gradually taking over from public sector banks as the main leaders in the country. They are also leaders in lending. Between the end of 2016 to 2021 period, the outstanding loans of public sector banks have gone up by rupees 14.4 trillion, which is equivalent to 180.26 billion US dollars, whereas the outstanding loans of private banks have gone up by rupees 22.8 trillion, that is US dollars 285.41 billion, which is a difference of almost 60%. This is the testimony of the private sector dominating the public sector in the banking system. Another recent change in the banking sector is the emergence of e-banking, which is crucial in offering better services to clients. Internet banking, e-wallets and mobile banking are some of the new methods that have replaced the traditional methods of conducting banking transactions. The reforms in the Indian banking sector have been introduced to increase the efficiency, stability and effectiveness of banks. Some of these recent reforms are National Asset Reconstruction Company Limited and India Debt Resolution Company Limited. The Union Finance Minister in the budget of 2021 announced the formation of an ARC AMC structure comprising two entities, that is National Asset Reconstruction Company Limited and India Debt Resolution Company Limited, for the purpose of aggregation and resolution of non-performing assets, that is NPAs, in the banking industry. NARCL, which is a government entity, has been incorporated on 7th July 2021 with majority stake held by public sector banks and balance by private banks, with Canara Bank being the sponsor bank. NARCL is registered with the Reserve Bank of India as an asset reconstruction company under Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act 2002, popularly known as the SARFAESI Act. The objective was to construct a bad bank which would house bad loans of rupees 500 crore, equivalent to US dollars 62.63 million and above. It is reported that there are already 28 existing asset reconstruction companies, that is ARCs, on the market. However, due to the sizable and fragmented nature of the bad loan book held by different lenders, significant amounts of non-performing assets continue to appear on bank balance sheets. Thus, more choices and alternatives like NARCL are required. This structure will have a dual component. It will consist of an asset management company AMC and an asset reconstruction company ARC to recover and manage stressed assets. It is a collaboration between private and public sector banks, that is the PSBs, but PSBs will maintain 51% ownership in NARCL. It will be capitalized through equity from banks and non-banking financial companies, that is NBFCs. If necessary, it will also issue new debts. The guarantee provided by the Government of India will lower the need for upfront capital. The NARCL will be assisted by the India Debt Resolution Company Limited, that is IDRCL. In August 2022, the NARCL offered to buy the distressed loan accounts of 5 companies, including Future Retail. India Debt Resolution Company Limited is a service company and operational entity whose purpose is to manage the assets of NARCL with the help of turnaround experts and market professionals. The NARCL will buy assets by presenting an offer to the lead bank. IDRCL will be included for management and value addition after NARCL's offer is accepted. Public financial institutions and PSBs will hold a 49% stake in IDRCL and the rest will be with the private banks. Another significant reform in the banking sector in recent times has been the digital rupee. In order to counter and face the challenges of cryptocurrency, the central bank's digital currency CBDC, that is the Reserve Bank of India's digital rupee, was announced in the Union Budget 2022-23. India's digital economy is expected to benefit greatly from the introduction of the digital rupee. A CBDC, that is the central bank's digital currency, the other name of digital rupee, is a digital representation or token of a nation's legal currency. A CBDC can benefit customers with better liquidity, scalability, acceptance, convenience of transactions with anonymity and quicker settlement. The CBDC or digital rupee as a legal tender that coexists with and complements the existing forms of money in a digital format. Similar to how UPI made digital cash is more user friendly, this development also is likely to increase the people's access to digital currencies. Adopting the digital rupee is expected to help cross border remittances and reduce the transaction cost for businesses and the government. Further, the digital rupee would reduce the settlement risk in the financial system. Another significant reform is the establishment of National Bank for Financing Infrastructure and Development, NABFID. NABFID as the principal development financial institution to support the development of long term infrastructure in India was announced in the budget of 2021 by the Government of India. Consequently, the Parliament enacted the National Bank for Financing Infrastructure and Development Act 2021, which received the assent of the President in March 2021, and the law has come into force with effect from 19th April 2021. NABFID has been set up as a corporate statutory body with the authorized share capital of 1 lakh crore rupees. It is regulated and supervised as an all India financial institution by the Reserve Bank of India under the Reserve Bank of India Act 1934. It is the fifth all India financial institution after Exim Bank, NABARD, NHB and SIDBI. Currently, it is headquartered at the Small Industries Development Bank of India, that is SIDBI's office in Bandra Kurla complex, Mumbai. Yet another major change which is welcomed in the banking sector is the setting up of an organization called National Payments Corporation of India, NPCI. It is an umbrella organization for operating retail payments and settlement systems in India, and it is an initiative of the Reserve Bank of India and Indian Banks Association under the provisions of the Payment and Settlement Systems Act 2007 for creating a robust payment and settlement infrastructure in India. Considering the utility and the usefulness of the objects of NPCI, it has been incorporated as a not for profit company under the provisions of section 25 of the Companies Act 1956, which is now section 8 of the Companies Act 2013, with an intention to provide infrastructure to the entire banking system in India for physical as well as electronic payment and settlement systems. The company is focused on bringing innovations in the retail payment systems through the use of technology for achieving greater efficiency in operations and widening the reach of payment systems. The 10 core promoter banks are State Bank of India, Punjab National Bank, Canara Bank, Bank of Baroda, Union Bank of India, Bank of India, ICICI Bank Limited, HDFC Bank Limited, Citibank and HSBC. In 2016, the shareholding was broad based to 56 member banks to include more banks representing all sectors. In the year 2020, the new entities regulated by Reserve Bank of India were inducted, consisting of payment service operators, payment banks, small financial banks, etc. The shares were allotted pursuant to the issuance of equity shares on private placement basis in compliance to the applicable provisions of the Companies Act 2013. The introduction of Central Bank Digital Currency CBDC also is a significant development. This development has the potential of bringing about a sea change in the fintech sector. The Reserve Bank of India on October 7, 2022 issued a concept note on CBDC, which proposed to introduce the digital rupee, as we discussed a few minutes back, as a legal tender that coexists with and complements the existing forms of money in a digital format. It is evident from a reading of the said concept note that the primary impetus for the RBI to explore the issuance of CBDC is to mitigate the systematic risk posed by private cryptocurrencies. The aforesaid concept note envisions two broad categories of CBDC, that is retail CBDC and wholesale CBDC. Retail CBDC is intended to be the general purpose digital currency, which would be available for use by private sector, non-financial consumers and businesses, while the wholesale CBDC is intended to be made available only to financial institutions, specifically for the purpose of interbank transfers and settlement of transactions. Following this, the Reserve Bank of India on October 31st, 2022 issued a press release stating the commencement of a pilot for wholesale CBDC for the specific use case of settlement of secondary market transactions in government securities, which was launched with the cooperation of 9 commercial banks. Shortly after, the Reserve Bank of India issued a press release on November 29, 2022, launching a pilot for retail CBDC, which covers selected locations in closed user groups comprising of participating customers and merchants. The retail CBDC has been issued in this pilot in the form of a digital token that represents a legal tender in the same denomination as traditional currency. Payments for both person to person and person to merchant transactions are enabled through a digital wallet offered by the participating banks, which are available on mobile phones and devices. While the introduction of CBDC and the aforesaid pilot programs is a forward step in the right direction, the effects and impacts of such a measure on the financial sector and public are yet to be seen. The next major change is introduction of Interoperable Regulatory Sandbox (IORS). The RBI, the Securities and Exchange Board of India (SEBI), the Insurance Regulatory and Development Authority of India, and the International Financial Services Centre Authority, through press release dated October 12, 2022, have introduced the IORS as a mechanism for regulating and encouraging the development of hybrid financial products and services falling within the regulatory ambit of more than one financial sector regulator. The IORS is intended to be a single window for fintech entities to interface with multiple regulators for the purpose of testing innovation and novel hybrid fintech products. The press releases also contemplate a standard operating procedure for the IORS. These procedures prescribe that the fintech department of RBI shall be the nodal point for receiving applications in the prescribed format. The regulator under whose regulatory domain the dominant feature of a particular product fall will be the principal regulator, and the regulator under whose remit other features apart from dominant feature of the product fall will be the associate regulator. The dominant feature of a product would be decided based on the type of enhancement to the existing product, like loans, deposits, capital market instruments, insurance, etc. 2. The number of relaxations sought by an entity to undertake the test, wherein greater weightage would be given to the first mentioned aspects above. The PR prescribes the eligibility criteria and the net worth criteria of applicants, while the AR provides specific inputs, conditions regarding the aspects falling under its remit. Upon the applicant entity successfully exiting the IORS, the PR and the AR are required to provide authorization for launching the product in the market on a wider scale. Government of India has recently proposed changes in the Banking Regulation Act and other laws. To improve bank governance and enhance investors' protection, the Union Finance Minister in February 2023 announced that certain amendments to the Banking Companies Act, the Banking Regulation Act and the Reserve Bank of India Act would be made. She further added that fintech services in India have been facilitated by our digital public infrastructure, including Aadhaar, PM Jan Dhan Yojana, Video KYC, India Stack and UPI. To enable more fintech innovative services, the scope of documents available in DigiLocker for individuals will be expanded. She also stated that an entity DigiLocker will be set up for use by MSMEs, large business and charitable trusts. This will be towards storing and sharing documents online securely whenever needed with various authorities, regulators, banks and other business entities. To conclude, it may be stated that the developments and initiatives which have been discussed before are only illustrative in nature and they are not exhaustive. Some of them are in the nascent stage. I advise the enrolled students to visit the official websites of the Security and Exchange Board of India, that is SEBI, and also the Reserve Bank of India and other departments' official websites and press releases to know about the latest position. Dear students, I sincerely hope that you have enjoyed watching this lesson. Let us meet in the next lesson. Thank you.